what they're not going to do is if inflation's above target and the equity market falls 10 or 20%, that's not going to cause the Fed to do anything.
Right.
If a bunch of real estate developers go bankrupt, the Fed's not going to do anything. It's only if basically something like the treasury market or something very adjacent to it has a problem. Banking, treasury market, that kind of thing is where they jump in. Things where you can actually get contagion pretty quickly.
Lyn Alden highlights a crucial economic tug of war, escalating central bank tightening, especially by the Fed, versus unprecedented fiscal stimulus leading to soaring deficits. Unlike past periods, rising interest rates now trigger fiscal challenges due to massive public debt, blunting their impact on money creation. Simultaneously, geopolitical tensions complicate the situation, with the U.S. involved in multiple conflicts. The key concern revolves around the escalating U.S. debt, which the domestic sector must absorb, potentially leading to a liquidity squeeze and impacting private sectors differently. Alden suggests an impending fiscal dominance scenario, where fiscal policies outpace central bank decisions, potentially causing a second wave of inflation. Stay tuned to uncover the full depth of these economic dynamics and their implications for global markets and finance.
I have been somewhat surprised by the resiliency of the stock market this year. Um, on one hand, it's not surprising in the sense that I've been in the camp that things like stock market and real estate in aggregate are going to be in this choppy sideways range for a while. So I was not one of those people predicting a big crash, not one of those people predicting like a melt up. My view is generally in that choppy nominal range, which is not good for just, year after year of real returns. And so this has been in line with that in the sense that we had a dip, we had a rebound, we're not at all-time highs. And so that plays out. But when I had made that prediction of choppy markets, if I had also known that treasuries would have gotten this high of a yield, then I would have assumed that as some of these big growthy stocks would have their multiples compressed more than they have now. So I'm a little bit surprised by the resiliency of the equity market. I've been a bond bear since like 2019, and the severity of this bond bear market has been surprising to me as a bond bear. Like I was not bearish enough on bonds. Um, and so I do think there's a little bit of a disconnect. It kind of reminds me of like February 2020 when commodity markets and other markets were sensing the issues that we're building in February 2020, and like in China and things like that. And the equity market was completely in la la land. And then eventually just went straight down. Like it was just like a comical once it realized that all that stuff's kind of coming to our shores, equity market goes straight down. Um, I don't necessarily, I'm not talking about anything that extreme, but it does feel like there's that disconnect where equities don't care until they do. Well, so I'll avoid doing that like kind of victory lap because it's well so one thing that the Treasury did well is that so I was concerned that there could have been a more acute liquidity issue this summer based on how they choose to refill their TGA, and that part did materialize in the sense that they mostly focused on T-bills to refill the initial burst
Mhm.
of it, which was kind of the most dangerous part of it. Like when you go from zero to like 400 billion, they navigated that. And that was one of the factors I said they could do if they want to avoid a liquidity issue. So basically, when the Treasury issues securities, they have all these different mandates for what they're trying to optimize for. They want to lower costs for the government, but they also want to ensure good functioning of the Treasury market. And so they basically chose to issue more on the expensive side of the curve, which was the short side, in exchange for that's a better liquidity situation because that can come out of the reverse repo. And that's exactly what happened. Basically, as the TGAs filled up, the reverse repo facilities come down. And so they've kept liquidity pretty flat since the March banking crisis. So like reserves are not being drained anymore. They're not being refilled either, like bank reserves.
Mhm.
Basically, it's you've had this kind of like seesaw. We're kind of seeing the second phase of it now in the sense that now they're back to coupon issuance. And so this starts to look more like how it could have looked had they not done that initial burst of T-bill filling. This is so basically they avoided kind of the first few months of a problem, and now they've kind of run into that now. It's still not acute enough. Like there's no seizing up in the treasury market. There's been elevated move index, but there's not quite acute signs. The treasury market became very kind of illiquid back in autumn of last year, around the same time, right before the gilt market blew up. I would say most signs are showing that even though the yields are worse, the treasury market is not quite as problematic as it was back then, but it's directionally been in that general direction. So, um, this is kind of like an ongoing issue. And one thing I actually wrote a newsletter called Treasury Market Dissonance back in August 2020. That's back when yields were almost zero on the long end.
Hmm.
And one thing and the reason I called it is because I started to see a supply issue forming back then. Um, and so it's obviously been a big zigzag to get there, but that was kind of the top of the bond market, and it's only been this like shocking fall in bond prices, shocking increase in yields. Um, and that's unusual for investors because when you look back at the 2010 decade, one of the unintuitive things is that when the Fed was doing QE, bond yields often rose. So they start buying bonds, and instead of driving those bond prices down, the bond prices, instead of driving them up, so bonds up, yields down, actually the reverse happened. But that's often because the private sector would then rotate into more risk assets. Basically, a liquidity injection was seen as a risk-on environment.
Hmm.
Um, but that started to change, starting kind of arguably with the repo spike, but then especially during the March 2020 sell-off, where we started to see more positive correlation, where the Fed buying does actively suppress bond yields, and when they stop buying, those bond yields push up. And so we are in this new regime, and so that kind of observation has been confirmed over the past few years compared to what the 2010s were like. So in some cases, this is a more intuitive regime because it kind of works as you'd expect it to, rather than the reverse of how you'd expect it to. So, I mean, after such oversold levels, I can see why there's a lot of interest in bonds. So I'm less bearish on bonds now than I was like, a few years ago. There are more interesting opportunities around in the bond market. Um, because I have a more inflationary view of energy, and because I'm still concerned about the ongoing supply demand characteristics of the bond market, I personally am not really rushing into, for example, go long bonds. I think the most interesting area of the market is probably tips. I do think that from a real yield perspective, there's some opportunities there. So you might say, well, I'm not necessarily bullish on nominal bond prices, but you could be bull. I could make the bullish case for why real yields probably are not going to go much higher, or
Not
if
going
they
to get any
do,
better.
yeah, if they do, maybe that's a second tranche. You buy a little bit more, but that they're not going to structurally just keep going up because that's how things break. So I do think from a real yields perspective, like a tips perspective, I think there are some opportunities. Um, when you get into the nominal territory, I mean, I'm sure there's tradable opportunities, but it's not exactly a market I would rush into to get involved with. Um, and I do think that we're in that more intuitive regime. And we already saw that, when there was a banking crisis, the Fed did jump in to kind of put out fires where they could. And, what they're not going to do is if inflation's above target and the equity market falls 10 or 20%, that's not going to cause the Fed to do anything.
Right.
If a bunch of real estate developers go bankrupt, the Fed's not going to do anything. It's only if basically something like the treasury market or something very adjacent to it has a problem, banking, treasury market, that kind of thing is where they jump in, things where you can actually get contagion pretty quickly. Or two, if you do get like outright recessionary conditions, then you probably have a repeat over again. So I don't think that people should expect the Fed to rush to the rescue. And I also think that when they do have to rescue, they would do the minimum that they can uh, to kind of put the fire out. But if inflation is still a problem, they're going to still want to be tight around the margins where they can be, which is not necessarily as good for asset prices as if they just throw the like a liquidity bazooka at the problem.
Here's a quick recap. We're witnessing a battle between tightening central bank policies, led by the Fed, and unprecedented fiscal stimulus resulting in skyrocketing deficits. Unlike the past, rising interest rates now collide with massive public debt, blunting their impact on money creation. Simultaneously, escalating geopolitical tensions further complicate the situation, with the U.S. entangled in multiple conflicts. The critical concern centers around the mounting U.S. debt, which the domestic sector must absorb. This situation raises fears of a liquidity squeeze, affecting various private sectors differently. Alden suggests an imminent shift towards fiscal dominance, where fiscal policies override central bank decisions. This could potentially trigger a second wave of inflation, especially if energy supply disruptions occur, or if the Fed struggles to tighten its balance sheet despite above-target inflation. If you found this analysis valuable, don't forget to like, share, and subscribe for more insightful content. Thanks for watching, and see you in the next video.